Hi, and welcome to the Green Course channel. In today's video, I'll present a visionary framework for accelerating early climate action by tokenizing industrial decarbonization. We'll start by revisiting classical economic models that shaped the industrial and further socialist revolutions. While foundational, these models failed to account for long-term environmental sustainability. Today, we find ourselves in the midst of information revolution, a transition to a new technological order, and an escalating climate crisis, making it clear that legacy approaches must evolve. Traditional economic thought, from Adam Smith to Karl Marx, laid the foundations of our modern systems, but failed to foresee the sustainability crisis we face today. Adam Smith acknowledged the existence of market failures such as externalities, but believed that the invisible hand would still guide markets to efficient outcomes, even if environmental costs were externalized. Karl Marx saw capitalism as inherently exploitative of both labor and nature, predicting degradation as a byproduct of profit maximization. While more critical of environmental impact, Marx's model still failed to provide a framework for sustainability and good governance. Practically, sociocentric models often sacrifice natural resources and ecosystems in the pursuit of industrial progress or ideological goals. Both thinkers, however, oversimplified the complexity of socio-environmental systems. Their followers, while advancing industrial progress, overlooked crucial planetary limits. These sustainability blind spots led to the real-world crisis, ecological degradation, inequality, and systemic risk, eventually prompting the global community to recognize the planetary boundaries and to adopt frameworks like Sustainable Development Goals. The World Economic Forum's Global Risks Report 2025 outlines a stark picture. Experts have identified top current global risks. The number one is state-based armed conflicts. The number two is extreme weather events, which is climate change. The number three is geoeconomic confrontations. While geopolitical risks are expected to evolve, climate change-related events remain a persistent second-tier threat. Critically, in a 10-year horizon, climate change is projected to be the number one global risk, reflecting the long-term systemic impact it poses. Wealth is conventionally measured as net assets minus liabilities, typically expressed in nominal US dollars. However, the real value lies not in just fiat currency, but in systems that secure stability, sustainability, and resilience. Historically, money was commodity-backed. Today's fiat currencies depend on government trust and economic stability. Increasingly, cryptocurrencies are entering the mainstream. The crypto market cap has surpassed 3.3 trillion US dollars, reflecting growing investor and institutional confidence. The IMF now recognizes digital assets in its balance of payments framework. Bitcoin is classified as a non-produced, non-financial asset. Stablecoins are treated as financial instruments pegged to reserves like fiat or gold, offering lower volatility and higher transactional efficiency. This shift signals the emergence of a parallel financial system, borderless, decentralized, and innovation-driven. According to the Swiss Re Institute report, The Economics of Climate Change, in a 3.2 degrees Celsius global warming scenario, the world economy could lose up to 18% of global GDP by 2048. This represents an annual loss of 23 trillion US dollars, a staggering reduction in productive capacity due to climate impacts like extreme weather, sea level rise, and agricultural disruption. The cost of inaction is now becoming quantifiable. Carbon budget is the upper limit of CO2 emissions the world can emit while still having a chance of limiting global warming to a target level, for example 1.5 degrees Celsius or 2 degrees Celsius. The current level of emissions is approximately 40 billion tons of CO2 annually. At this pace, the 1.5 degrees Celsius budget will be exhausted by the end of 2025. The 2 degrees Celsius budget will be depleted by 2042. This carbon budget is a global public good, essential for preserving long-term economic and planetary stability. Its preservation must become a central objective not just for governments or NGOs, but also for financial markets. To avoid 18% GDP loss scenario, early climate action must become attractive to investors. Yet the climate finance gap remains wide. Funding for mitigation and adaptation is still 3 times below what is needed. Despite treaties, nationally determined contributions, and growing awareness, structural incentives for early, scalable climate action are insufficient. Digital currencies and blockchain offer a breakthrough opportunity. Tokenizing verified emission reductions, especially in heavy industry, could turn climate progress into a tangible, tradable asset. Mining a climate cryptocurrency backed by verified greenhouse gas emission reductions would reward real sector decarbonization, unlock private capital for early climate action, deliver measurable carbon budget savings. A pilot blockchain platform linked to the real-time greenhouse gas data from industrial sites could track verified emission reductions, issue stable, value-backed climate tokens, facilitate climate investment with speed, transparency, and traceability. This is not just a financial innovation. This is a paradigm shift. A system that aligns financial returns with carbon budget preservation could finally bridge the gap between climate urgency and capital deployment.